Welcome to Founder Filing. If you're a new LLC owner wondering how estimated quarterly taxes work and whether an S-Corp election changes anything, this head-to-head breakdown will walk through the general concepts side by side. In general, business owners who expect to owe tax must make periodic payments to the IRS instead of waiting until year-end, but the exact approach depends on how the business is taxed. This is general education and entertainment only, not legal, tax, or financial advice, and viewers should consult a licensed CPA or business attorney about their own situation. The tools shown are linked below, some of which are affiliate links that support the channel. We will compare the default single-member LLC path against an S-Corp election using the same criteria, so you can see where the processes overlap and where they diverge. By the end, you will understand the basic mechanics, the record-keeping differences, and who each structure tends to suit, always remembering that rules vary by state and change over time. Estimated quarterly taxes are advance payments toward income tax and self-employment tax that many self-employed individuals and business owners make throughout the year. In general, these payments cover the owner's share of Social Security and Medicare, as well as federal income tax on business profit. For many founders, the goal is simply to avoid a large bill or penalty when they file the annual return. The process starts with projecting annual profit, subtracting allowable deductions, and then dividing the expected tax into 4 installments. Because thresholds and amounts change every year and vary by state, founders check the current IRS figures or ask a CPA rather than relying on last year's numbers. Both the default LLC and an S-Corp election require these payments when profit is high enough. Yet the way profit is calculated and who pays what differs, which we will examine next. Under the default taxation for a single-member LLC, the business is disregarded for tax purposes, so all profit flows to the owner's personal return. This means the owner typically pays self-employment tax on the entire net profit in addition to income tax. A common approach is to estimate total profit after expenses, apply the current tax rates, and send 4 payments. Many founders use bookkeeping software, such as Wave, to track every invoice and receipt so the profit figure stays accurate. Because there is no separate payroll, the owner is responsible for the full self-employment portion. Liability protection depends on following formalities and is never absolute, so keeping personal and business finances separate remains important regardless of tax treatment. When an LLC elects S-Corp status, it becomes a separate tax entity that files its own information return. The business must pay reasonable compensation to shareholder employees through payroll, and only that wage portion is subject to payroll taxes. Remaining profit passes through to the owner without additional self-employment tax. In general, founders still make estimated tax payments on the pass-through income, but they also handle payroll tax deposits separately. Tools like QuickBooks help separate payroll from distributions and keep records clean. This structure adds administrative steps, such as running payroll and filing Form 941. Yet for many founders with consistent profit, it can simplify the overall tax picture once the extra compliance is managed. Rules vary by state, and professional advice is essential before making the election. The calculation method shifts between the 2 structures. With a default LLC, the owner estimates net profit, multiplies by the combined income and self-employment rates, and divides by 4. An S-Corp requires first determining a reasonable salary, calculating payroll taxes on that salary, then estimating tax on the remaining pass-through profit. Both approaches need updated profit projections each quarter because business income rarely stays flat. Founders often review bank statements and expense categories at the end of each period to adjust the next payment. No guarantee exists that following any method will eliminate underpayment risk, which is why checking current IRS withholding tables or speaking with a tax professional matters. The key is maintaining the same disciplined estimating habit whether the business is taxed as an LLC or as an S-Corp. Strong records support accurate estimates for either structure. A default LLC needs clear separation of business income and expenses so profit can be calculated quickly. An S-Corp adds payroll records, W-2s, and payroll tax deposits that must reconcile with the business return. Many founders adopt bookkeeping software, such as QuickBooks or Wave, because these platforms categorize transactions automatically and generate the reports needed for quarterly estimates. Good records also protect the limited liability status by showing that the business was treated as a real entity. Liability protection depends on following formalities and is never absolute, so consistent documentation benefits both paths. Updating the books monthly rather than quarterly makes the estimating process far less stressful when the next payment date arrives. New founders often underestimate profit early in the year and then face a shortfall later. Another frequent issue is mixing personal and business expenses, which distorts the profit figure used for payments. Some owners assume the S-Corp election removes all quarterly obligations, yet pass-through income still requires estimated payments. Others skip record reviews after the first quarter and miss changes in revenue or deductible costs. Using the same bookkeeping system throughout the year helps catch these shifts. Because amounts and rules change every year, founders treat last quarter's payment as a starting point only and recalculate each time. Professional guidance from CPA remains the safest way to tailor the process to individual circumstances. In summary, both the default LLC and an S-Corp election require estimated quarterly tax payments when profit is sufficient, yet the LLC pays self-employment tax on all profit while the S-Corp shifts part of the burden to payroll taxes on reasonable salary. Record keeping is essential in either case, and tools such as QuickBooks or Wave make the work manageable. This is general education, not legal or tax advice. Consult a CPA or attorney about your situation because laws, amounts, and deadlines change and vary by state. Subscribe to Founder Filing for more straightforward small business guidance. Knowledge is power when it comes to your business taxes. Founder Filing.